You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, a lot to talk about here today on episode 132 of the Reinvest Podcast. So we've got an interesting predicament if you're an investor in today's market, right? Interest rates aren't moving, but savvy investors have got to get creative. So we're going to talk about how to thrive and not just survive in today's high interest rate market.
Well, you're still getting a lot of there are no deals right now because expectations are still high. Prices really haven't come down, at least in our area. You know, in the Midwest, prices have not adjusted very much from the highs of COVID, and interest rates are still high. So, you know, they're like, things are feeling tight right now. But I think despite high interest rates, there are things that we can be doing in our portfolios to either maximize what we have or think about deals differently, because there are good deals out there. There are good deals in any market. You just have to make them good deals.
I talked to an investor who went to a real estate investing conference this last year, best ever, back in the spring. And he said the tone was way different this year. So like we went in 22, 23, I think. Everybody's real excited, high-fiving, large crowd, big pull, good blend of active investors, limited investors. You know, their money was flush.
Fast forward in 2023, it was survive. The slogan that year was survive until 25.
Yeah.
That was when interest rates started shooting up, you know, and then the sentiment became quickly, if you can survive and hold out the next couple of years, you'll be okay. And then 2025 has rolled around, and the attitude has changed even more.
Mm-hmm. And, you know, the attendance was way down. People not as excited. The messaging was more of like, hey, if you're in distress, here's what to do. And it's just been interesting, I think, to observe as a newer investor, watching the messaging change and the excitement level change as we transition into a different market. So the answer, though, is not to sit on the sidelines. So that's why you're listening to this episode, because you need to know what's on your tool belt and what's your game plan while we just wade through these macro level things in the economy. So we're going to talk about 3 different categories of how you can be an active investor. And number 1 is going to be creative financing. So we'll unpack that a little bit. Number 2 is how to reposition assets that you already own. And kind of dovetailing with that is how do you spend capital wisely so that you can maximize rent, because rents are still strong, and that's kind of the saving grace right now. So let's jump into that. Give us kind of a current condition, like where are we from an inventory perspective, affordability, interest rates, and then we'll get into these strategies.
I think inventory probably almost everywhere, but especially in our area, is still historically low. It's on the lower side. You know, in our market, there's only a few hundred houses in the market, and that's it. I mean, and so interest rates are holding around that 6.5 to 6.75 for consumer 30-year fixed. I mean, commercial stuff is in the 7s still. Mm-hmm. And so, and sentiment from the bank perspective has just been, they've been a little bit more, you know, backing away from the investment grade stuff.
Yeah.
They've been more conservative. And it seems like I was even having a conversation today that these underwriters for these loans are even getting more picky about condition issues at houses and requiring certified home inspectors to go back out and sign off on things, or having foundation inspectors, you know, structural engineers go out and sign off on things. And it's becoming more and more common. And so we're seeing, from an industry perspective, everybody's starting to tighten up. I mean, I think just the longevity of everything has made people even tighten up more. Now the interest rates have been in this range for the last 1.5 or 2 years or whatever it's been.
What was that statistic that you said the other day about where inventory, like transaction volume wise, where we are where we were in 2019?
Yeah, like the volume that we had this last month or this last quarter was the lowest transaction volume that we've had since 2019.
It's putting a pressure on real estate agents who obviously need multiple, you know, transactions is kind of the lifeblood of that. It also means investors are doing lower deals, you know, lesser deals. People are getting pickier because cost of money is higher. So,
but I think if you're looking to get in the game, though, the time isn't to wait. It's not to wait. It's not wait to get in the game until interest rates go down. You've already missed it at that point. The best time to get in the game is now, and just to get a deal done that makes sense. It doesn't have to be a home run deal, but if you can get a base hit and you can keep moving the ball down the field incrementally, that's how you're gonna do great things.
Warren Buffett says that risk comes from not knowing what you're doing. So get in the game, but know what you're doing, which is why you have these strategies. So number one is creative finance. These are ways that savvy investors are sourcing deals in a tight inventory environment. So different options here. You've heard us talk about this on the podcast. There's a lot of landlords right now that have been in the game for a long time. They're tired. They're wanting to make a transition. I know we have investors that come to our meetup that have relationships with these guys and kind of have an inroad to incrementally buy deals and have a scenario where that seller will finance either the down payment and then get the balance from the bank, or be kind of the complete financier, right? You bring 10% of your own capital to give the seller some upfront money, and then they hang on for maybe 5 years and get some of the tax benefits of spreading that incremental sale over that time period. That's a viable strategy right now. You need to know why that would be advantageous for somebody so that you can pitch it. One strategy, I think this came from Alex Hermosi, when he's offering on something, never just put out two scenarios or one scenario. Like, oh, well, if I'd have to buy it, I'm going to buy it at this price. Price is just one variable in a negotiation. Terms are another variable in the negotiation. So you could throw out two options when you're working with somebody, and you don't know what they're going to say yes to if you don't know their motivation. You might say, hey, I could buy it for this, and I would just go finance it traditionally. Or option B is, I could do this over here. Maybe you're going to give them a little more money, but they're going to finance it for you. Again, presenting multiple options to a seller, I think, is a good strategy. Other forms of creative finance, sub 2. I personally don't feel like super versed to be able to kind of speak on that.
And I hear so many mixed things. There's a lot of, if you haven't heard of subject to financing, I mean, one of the leading voices on it is Pace Morby. So you could just Google Pace Morby and that's what will come up. But I hear so many conflicting things on subject to financing from reliable people all over the internet. People for it, people against it, people saying it's unethical, people saying it is ethical if you're doing it correctly. And essentially, if you don't know what subject to financing is, it is essentially finding a distressed seller, most likely, because, there's a reason they wouldn't just sell it outright and cash out. Maybe they're underwater on the property. Maybe there's condition issues preventing them from being able to sell it. Something is going on. And so you would essentially come and maybe you would give them some cash up front to take over their mortgage, essentially. They would give you their login information to pay their mortgage, and you would essentially just take over the mortgage. They would sign over the deed to you, and you would have title to the property, but they essentially still have all the debt under their name. And it sounds really good because it probably is. It probably is really advantageous. It sounds like you could have some really good returns, especially if someone was locked in at a low interest rate and you could give them money to take over their loan. Where you run into some trouble is if what happens, kind of the ethical side of that, is what happens if you default on that loan or you just stop paying it and you screw that person's credit. You know what I mean?
Right.
I think there's some things like that. You have to be a person of integrity anyway. So, if you are a person of integrity, I think you could probably make those deals work.
Well, I think the other thing too is don't just make the assumption that because it's a subject to, it's a good deal. Like at the end of a day, no matter what kind of creative finance you're looking at or a real estate deal, boil it down. Income, expense, return. So you have to look at that stuff, even as subject to. The interest rate might be 2.6% because somebody locked that in.
A turd of a property is still a turd of a property.
It's still, overpaying is still overpaying. So don't just assume because it's being offered as a subject to. Like these companies that put these subject to deals out there, obviously it's their goal to market it in a way that seems appetizing. So just know what you're doing, but it could be a viable strategy. One more thing kind of in the creative finance is rate buy downs. So I just closed on a property. It was a single family home purchase, very simple. It was a for sale by owner actually. So again, these deals are still out there. that you can find. It's just you're having to look a little bit harder to do it. Went to a bank, commercial loan, and we had different loan options. I'm still in the mindset of trying to fix my interest rate as long as I can, even if it means the interest rate's higher. It was 7.5%, but I got 2 years longer on that initial fixed term versus the 3.3, and it was like 7.25. And the reason I did that is that 0.25% to me higher, but having it 2 years longer is worth it to me. So just evaluate your loan product and know that you might be able to kind of weigh out the risk reward of buying down the points, paying points to buy down the rate, and locking it in for as long as you can.
Can you explain what that means for maybe someone out there that has never heard of that?
Yeah, so banks will let you pay money up front to make the interest rate on the loan lower. And so sometimes it means bringing more money to closing to have a lower interest rate. And you can model it out to see if that makes sense for you. We have a lot of residential buyers do that from a real estate perspective. They'll ask for closing costs, and the seller will effectively pay down the rate of their loan. And that can ease up the monthly mortgage obligation and increase your cash flow. So, okay, strategy number 2 is repositioning your existing inventory. Seth, you actually brought this up the other day as maybe a strategy that you're going to explore. So I'm going to hand this to you because you can unpack it.
Yeah, I mean, I was just thinking about the properties that I have currently. And, even since I've bought these properties over the last few years, rents have continued to rise. And so I'm looking at my portfolio and I'm like, I've had some of these tenants in here for a couple of years now, and they're good tenants. And, I'm thinking about buying more properties, but now I'm kind of at a juncture of like, okay, why buy more properties and add on maybe some of the management headache of more tenants and all that, when I could probably use that same money and get similar returns by optimizing my current portfolio and getting market rate rent. And so I have some properties that are, hovering around $700, $800, $900 in that range for some of my units. And I'm probably leaving $100 to $200 on the table if I, improve those properties and get more of a market rate rent. And so I was kind of talking this through and thinking it through, and I could probably go in some of my units and, spend $10,000, new flooring, new paint, maybe updating the kitchen or new countertops or something, and actually getting like $100 to $200 rental increase on that unit. And I think, it's probably pretty realistic. And so then you start looking at that and you're like, that's, $1,200 to $2,400 a year. That's really just coming straight to the bottom line of my cash flow. And that's like a 12 to 24% return if I spent $10,000. So just a different way for you to start looking at your portfolio and where can I spend money that's actually going to correlate to an increased amount of cash flow. And so I could spend $10,000 and maybe get a 20% return on that money, cash on cash return. Or I could spend that same $10,000 or $20,000 and buy a new rental. Am I going to achieve that return? Is it going to make sense? Is the headache, the stress, and all that going to be worth to make an extra 5 to 10%? You have to weigh all that out. But just something I'm considering for my personal portfolio as I'm looking to maximize the cash flow I'm receiving from my existing units.
There's a couple other needle movers, I think, in that strategy is if you're updating your properties, there's a good chance that you're going to be updating maintenance-related items that are going to lower the maintenance costs that you have in a year for that unit. So you're kind of creating a spread in two different directions there by creating more top-line revenue and reducing your expenses. Mm-hmm. Another one is energy-efficient upgrades. There's a lot of interesting ways to optimize your portfolio. You might have an insurance provider that if you make certain improvements to your property, i.e. smoke detectors or, energy efficiency related things, there might be some kind of a kickback on the other necessary services that you're paying for. And, in a scenario where you might be on the hook for some of the utilities, like in a multi-use building, that energy efficiency is a big deal and a way to lower expenses. So there's stuff I think we have been so conditioned to think new acquisition, that when things are now slowing, we're like, oh, well, we're twiddling our thumbs. We feel antsy. You're forcing deals because you got that high and that dopamine rush of buying a new deal, but not realizing that there are ways to increase cash flow with what you own. And ultimately, it's stabilizing a foundation so you can continue to build on it.
Yeah.
These are more paper improvements. So strategy number 3 is arbitrage time, not just price. So locking in long-term leases with built-in escalations. Review your leases. Do an audit right now on some of those lease agreements that you have overlooked because you haven't had time. You've just been so concerned with getting it occupied and you've thrown it behind you. Revisit those things. As leases come due, think about what kind of increases can take place and the market could bear without even creating a turnover.
I think, we run into a lot of landlords who are like, yeah, I know it's under rented, but don't want the turnover. I just don't want to deal with that. And, there's a certain point where if you're close to market rate rent and it's like, okay, yeah, maybe you justify that by you don't want the turnover. You don't want to try to get it to market rate rent. But some people are literally $300 and $400 below where they should be. And even doing a small increase on a lease renewal would make a huge improvement to their returns. And so I would think about that too. Even if you don't want a turn, increasing someone's rent $50, they're probably not going to move because if they're already that low, they're probably not going to find a comparable property to move into. So something to think about. You're not trying to take advantage of people, but legitimately our insurance costs went up 60%. So there are actual expenses that are eroding your cash flow if you are not doing any increases at all.
Yeah, that's well said. Well, this is a quick one, but let's break down some action steps here. So number 1, audit your current portfolio. Where can you begin to spend money to gain rent or equity? Build a seller finance offer template. Don't be afraid. On one of our past episodes about how to make offers quickly, we talked about being comfortable throwing out letters of intent. When you throw a letter of intent out there, really what you're doing is you're just indicating and signaling to a seller that you're a legitimate buyer and you're putting a number that makes them think in front of them. So if you've got people who have kind of kept you at bay and they're like, well, I'm not ready to sell yet. Oh, I'm not ready to sell yet. I'm taking a new strategy just to throw out letters of intent. And you don't know when they might take you up on that. And they're like, man, I was actually thinking about it. And what you're doing is you're pushing them to actually think seriously, because these sellers, information so readily available, they get solicited on the weekly about their properties. And usually it's very kind of casual, non-tangible stuff like, would you sell? And you're just white noise amongst all of them. So build a seller finance offer template, put it in front of somebody. Don't be afraid to shoot your shot. And if you're afraid, then you probably don't have enough information, or there's some fog about your strategy with what you would do with that portfolio. If you are interested in subject to, do your research on it. Don't just jump into it because it's kind of a craze. And then I would encourage you, just continue to put those effort into lead funnels, wholesalers, for sale by owners, the people, the real estate networks. There is still churn happening. Think about longtime property owners who, even though the market may not be putting motivation on them, they may feel motivation because they're getting older and maybe their kids are taking over the property. Those are things that will have to be dealt with regardless of the market conditions. So don't be afraid to continue networking with people. We are going to end with our quote of the week. I love this one. When you think about building a business, this is massive. It takes 20 years to build a reputation and 5 minutes to ruin it. Charlie Munger. What do you think about that?
I think it's important to be honest and have integrity. So
invest for the long haul.
Yeah.
Don't be transactional. What I think is so wild is if you just listen to the voices of people around you, you will torch your reputation without even knowing it. You have to have a clear direction on how you got to where you are, and don't get short-sighted. I think it can get really easy to take shortcuts and cut corners because you feel like you're getting behind, or, you're comparing yourself to somebody else. Put your head down. Once you have your plan, work it, and forget about other people and maintain your reputation, because it is like one of the biggest currencies you have.
Yeah, that's good. All right, guys. Thanks for the episode today. Thanks for listening. If this episode gave you some new tools, please share it with another investor looking to grow their business.
As always, excited that you joined us for another episode of the Reinvest Podcast. If you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, reinvestcapital.us, and shoot us a message. Move farther, reach higher, and grow deeper.